The picture is getting a bit more difficult next year, especially under the consideration that President Trump has announced some tariff measures which will undermine global trade. I think it will lead to the global economy being a little bit worse off next year, so that in the West and the US we still have quite okay growth rates. For Europe it will look a little bit more difficult. We are at recessionary levels right now, and the lack of the destination for exports in the US will undermine this as well. And China has to find its way a little bit more. But I think emerging markets in China will have quite good support for growth next year. So altogether, I think growth will be slightly lower. The US will do a lot for the small and mid-cap company segment. In Europe, more difficult, and there are valuation opportunities in China and emerging markets. The inflation risk is the highest, I would say, because the tariff measures that lead to, leaving out competition for the US, but also the US companies lack some product they need for their production process, for the supply chains out of Asia, out of China. If they don't have that, they cannot, make the same sales or earnings potential as they did. And also with immigration policies, it looks like if you expel some of the workforce in the US, the job market gets more difficult and maybe labor rates go up. So that's inflationary. If the Fed is then pausing their rate cutting cycle, that is more difficult for the small and mid-cap companies, and therefore the risk is inflation, and the risks are of course geopolitical risks. I think that's another point. How is the Ukraine war doing? How do we end up in the Middle East? And how does the big confrontation between the US and China go along? So I think those are the risk factors on the main basis. I think I wouldn't totally rule it out. If inflation rates pick up really a lot more than people anticipate, the rate could even think about a hike. But I think next year it's not on the agenda. For the time being, it's more a pause and a slowing down of the cutting cycle. But for next year, I think that, Fed rates are probably, we probably might see, one or two more cuts or so, but then a pause is very likely. And then I think the pressure will increase because Trump will be very interested in low rates because of his high debt burden. But Powell has already stated that he will go against inflation pressures and he will, adjust policy accordingly. So there will be some confrontation, I think, between the two, and we have to see how the government reacts, because he can't force Powell to leave office until 2026. They might announce someone who's basically from government friendly and stand on Powell's toes all the time, and that increases pressure as well. But for the time being, I think if anything, Fed policy will be more stricter than people anticipate right now. I think that will be even looser, if anything, because if you think about the global economy and capacities being held out of the US, exports not finding their way into the US because they put up borders, tariffs, I think the same goods have to find, or the same capacity has to find new destinations, and that means that the price pressure is probably going down. And that, added to the very slow economy in Europe as well, I think that will lead to the ECB probably dropping interest rates further. I know we've heard from some ECB speakers like Isabel Schnabel that they shouldn't drop rates too quickly, but I think the economic situation is not great, right? It's we are struggling on a recession right now, and the growth expectation is not very high. And then at the same time, prices might be falling, so they have good arguments for further cutting rates. If that is now leading to 2% or 1.5%, both could be, but I think it's not 3%. So there is a bigger interest rate differential between the US and Europe next year. The dollar should increase or should be stronger if in that kind of circumstances, because if US rates remain higher than anticipated, and if European rates drop further, the rate differential should actually benefit the dollar and should force capital inflows into the US, because people want to be exposed to the US and the differential speaks for it. I think for next year, the dollar could be well supported. But then again, all those deficitary measures in the US, they will slowly undermine the trust in the dollar, because the debt levels have risen quite substantially. We're at 120% of GDP right now, and Trump is already probably indicating of increasing that debt levels even more by lower taxes and things like that. So I expect that at some point the trust in the dollar will weaken, and therefore the dollar is reaching its peak at some point during next year. So yes, it might be stronger for the next year, but then on a midterm outlook, I expect the dollar to go lower because of the huge debt burden of the US. It's very tough to really call for a certain rate, but it's not a lot higher from here. So the parity could be, now it's 104 or something, we're not far away from it. So maybe sometimes traders, they are looking for certain marks that they want to reach, and so we could reach parity, but that's the max. I wouldn't expect the dollar to go stronger than that. If you consider that from a pure trading perspective, then for a longer term perspective, you're probably better off betting on a lower dollar than on a higher dollar, because the room to the max is not that high. I think it's getting a bit more difficult because you cannot just easily buy the indexes, for example, the S&P 500 or the stocks or whatever. I think the alpha will be made by individual stock selection. So I think the index levels will not provide that attractive levels again that they have for the last 2 years. So S&P like over 20% plus for 2 years, and in Europe we've had like 5% and 15%. I think it will not be that easy again. So I think probably the index, the beta levels will not rise a lot higher. But on an individual basis, attractively valued stocks will be much more important. So I think an active investment process is relevant. Despite the fact that we have run up very high, I would still favor equities overall from a pure risk asset perspective in the mid to longer term. Fixed income has provided a good diversification, but I think in an inflationary scenario, the attractiveness, the relative attractiveness to equities is not as high. If you are a bit conservative and risk aversion is high, then I would put some fixed income there, but equities would still be the overweight, even despite the fact that we have highs in the equity markets. And then commodities would be one of the asset classes that I would put in, because I think we have had an underinvestment for the last 15 years or so. There's a lot of supply needed in the next few years, be it for energy, be it for infrastructure altogether. Commodities are a sector that are a bit neglected, and I think they will come back. Gold being one part of it, because gold is a replacement asset for, let's say, the dollar. Central banks don't want to be exposed to the dollar again, so I think they replace a little bit the US dollar assets by gold. So I think commodities would be an interesting third one. And then if you have the opportunity to provide some alternative assets in your portfolio, some that are not so much correlated to the rest, some private assets. That depends a lot on where the interest rates on the short end will go next year altogether. But I'm actually more towards the bear steepening in some ways, because I think that we go to a slower part of the economy. I think the earnings per share from equity markets will probably not be as positive, and therefore we go from a good economic situation into a slowing part of the year. So more towards the later part of the cycle rather than the earlier part of the cycle. That's why I prefer a bit more defensive sectors altogether. And in the US, I think, the spreads are already very tight in the corporate sector. I think with the debt that we need for financing Trump's ideas, I think therefore, rates will probably push up yields further on the long end spectrum. So therefore, I'm not as keen on the US interest rates and the US corporate sector. I would rather prefer the European ones, because where interest rates are falling, I think it's a more attractive landscape for fixed income. But in Asia, I think that's quite attractive, because the growth is still good. You have good growth numbers in China, India, Indonesia, things like that. And the credit spectrum, like in investment grade yield or in high yield, are by far not as compressed as in other parts of the world. So I think that provides some interesting levels for fixed income investors. It looks more attractive to invest in the US than in Europe because of the economic growth expectations. I think growth in Europe is low. We are at recessionary levels, and the central banks will have to cut further. Growth is much more attractive in the US. I think Trump is really providing some support for the corporate sector by lower tax and everything. The inflation aspect is another one, but still it comes so to speak, at higher growth numbers. So the US, I think, is preferable to Europe. But as I said, on an index level, I think the higher valued sectors like the Max 7s or so, they will not provide the same backbone as they have, because their earnings relatively to the rest of the sectors are slowing down. So you can see them peaking out and growing earnings growth from, like, I think 40% or so, coming back to a more normal 30, 25%. That means valuations have to come back. But that means for the rest of the market, there's some catch-up potential. So on an index level, you cannot get the same reward as you did for the last 2 years. But for other sectors like, let's say, financials, or let's say consumer staples, or healthcare, I think those are attractive sectors which are not as highly valued, and they provide good opportunities when the whole market is broadening out. So I would rather call for catch-up potential of the sectors that have not performed that well versus the really highly valued sectors that have been doing well for the last 2 years.